Hello everybody, welcome back to a new YouTube video. So in this one I'm going to talk about order blocks, aka supply demand zones, aka my approach, aka whatever, right? Now there's so many videos out there on order blocks, and don't get me wrong, there's probably some valuable ones as well, but honestly it's just a lot of nonsense. I'm not trying to diss anyone, but you have to be careful who you listen to. If you check out my Trader Luke FX page, I talk about everything there, and you'll understand what I'm trying to get at here. So enough of that anyways. Probably one of you, at least a couple of you who are watching this right now, I've had a few DMs about, hey Luke, can you do a video on order blocks please? I'd much appreciate that. So you know what, when you're kind, when you request something nice like that, of course I'm going to do it for you guys. So order blocks, well, let's just jump straight into it. So order blocks are just essentially a build-up of orders from the BFIs. So BFIs just stands for banks, financial institutions, and you can call them central banks, financial institutions, you call them whatever you want. There's so many different names for it these days, it's crazy. So in essence, order blocks are just special supply demand zones, right? As we know, the BFIs mainly drive the FX market. Therefore, when price is consolidating, they are building the orders. And at this point, most of the investment decision takes place. So write that down. So when price is consolidating, they are building up the orders. And at this point as well, so when price is consolidating, most of the investing decisions take place, right? And this to me is all about having perspectives on the markets. And when you have a really deep perspective on the markets, you can sort of project what's going to happen next in your mind before it even plays out. Whether that's down to experience or not, I don't know. But I feel like if you can understand not only the why of things and the how, if you just have a really deep perspective on certain things and why they do what they do, you'll really understand things. So anyways, when the order is completed, so obviously, when it's price ranging, they're putting in orders. When it's completed, the market tends to make an impulsive move or a sharp move on either side of the markets, right? So this, it's just, like I said, the way I view the markets, it just helps me, what's the word I'm looking for? It just helps me sort of make these decisions that I make on a daily basis. Anyways, moving on, sorry. So the name order block explains itself when you really dig deep into it. So order block, right? So when you dig deep into that, we look at what an order means. So order means buying slash selling, right? And a block, when you look at the other word for a block to help clear things up, it stands for a significant amount of a certain asset. Or no, a significant amount of something, right? So something. So when you put these two together, obviously order block, it stands for buying or selling a significant amount of certain asset, right? And again, this is where the order block name got itself from anyways. So something to take note of here is that the banks cannot place their positions all at once. So what they do is they break their positions down into smaller chunks. So if we just take a look at an example of, how things are run from, let's say, a bank's perspective. So let's assume that JP Morgan wants to place a buy order of $100 million. So they have $100 million on your dollar, but there's only $25 million being sold. Now, when we go back to the absolute basics of the markets, we understand that in order for there to be a buyer, there must be a seller, and in order for there to be a seller, there must be a buyer, right? And it's the same process for, for example, if I take a buy on your dollar, and you who is watching this take a sell on your dollar, let's say you win that trade, that means I have lost that trade, and vice versa. So that means you have taken money from me, I've taken money from you. So there must be enough orders going around. So if we go back to what I was saying, so it's obvious that JP Morgan might not be able to place all of their orders, as obviously not many people are selling it. So they have 100 million, but there's only $25 million being sold. So if they place a buy order now, their $25 million order will be executed now, while the remaining $75 million order will be filled or put in at an ever increasing price, because obviously when the market goes up, people can be selling, right, resulting in lowering their profitability. So hence they decide to split their order and use order blocks to place and manage their position. If they split their position into chunks of $10 million, they'll be able to place their order without upsetting the price too much. Okay. For example, if they place their first chunk of $10 million, which is a buy order, it will not create a sudden jump in the price, as selling is still greater than buying. So you got $25 million selling versus $10 million buying, right? Then they can wait for more orders before placing the next chunk of long orders. Okay, this process of placing chunks of orders results in creating a supply demand zone from a consolidation phase. Okay, so they're not trying to upset the markets while placing all the positions at once. They'll obviously split it into smaller positions using order blocks. So that's essentially the whole sort of order blocks explained, I guess. It may not make too much sense, but like I said, just go and watch this video loads and loads and loads. But like I said, order just stands for buying and selling. Block just stands for a significant amount of something. So order block stands for buying, so selling a significant amount of a certain asset. Okay, and obviously, like I said about the whole chunks of things, that's the order block. Okay, so trying to just think of other things I can explain now. So if we just take a look at, let's say, this bullish order block here, right? What I'll do is I'll get this pen tool. So as you can see, we have this last down candle before this up move. So like this, right? And essentially what the whole sort of theory is that price will come back down, tap into that order block before creating a higher prices. But this is where we tie it in with things like market structure to make sure we're on the right side of the market. Because what a lot of people do is they'll see like, oh my God, there's such a huge shift in momentum. Let's buy from this order block. But in reality, structure is so important that, it just fails. We then usually flip and do something like this. And that's called a breaker. And I'll explain the breaker block later on. But if you understand order blocks first, you'll be able to easily understand what a breaker block is. And like I said, to me, it's all about perspectives as well. So that's the bullish order block. So a bullish order block is the last bearish candle before the up move. So obviously the down candle before the up move, and vice versa. So bearish order block, that's up candle before the down move, and essentially price should come back, tap into it before creating a lower price, etc. Right? And that's essentially how the whole sort of order blocks theory works. Now, again. I'm trying to think of anything else I've missed. I don't think I have, to be honest. I'll show you a real life example. But before I do that, I want to go on to explain what creates a valid order block. So a valid order block, it can't just be any random order block. What have I done now? Sorry guys, I can't just have a nice video, can I? There's always got to be a problem, eh? Anyways, as I was. Right, there we go. So, essentially, sorry guys, that just threw me off completely. It's like when I'm talking for so long and then I just sort of lose my train of thought. I'm easily distracted, to be honest. That's why when I'm trading, this is a little tip for you guys as well. When you are trading, put all these things away. If you have an iPad, put it away. If you have a phone, put it away. Your computer, obviously you're going to be on a computer, but just shut other things off. Don't get distracted. You need to be trading in the zone, literally in the zone. Shout out to Mark Douglas. Anyways, what validates an order block is a imbalance. So if you don't know what an imbalance is, I'll do a brief run through on it now in a minute. If you also, what validates an order block is a break of market structure. So if you, I'll do these examples for you in a minute. So just take notes. So what validates an order block is an imbalance, break of market structure. What else? You can usually look for ones that are swept liquidity. So for example, if there was previous, equal lows here, if I can get the pen tool. So for example, if there's equal lows here, and then price created this, sweep of it, and then an order block before the huge shift in momentum, then that's a nice high probability order block, right? So a sweep of liquidity, not always is a sweep liquidity though. Break of market structure, an imbalance. I've got it all written down in the course, to be honest. And also, last one as well, premium discount. So obviously, what I'll do is now I'll just jump onto real life chart and show you what I mean by premium discount. So if you just take a look at this, right, what you can see here, obviously this is an order block, but I'll explain to you why it is in a minute. As you can see, an imbalance is essentially where the third candle low and a first candle high do not meet, and there's a gap between that, okay? So the second candle is, in this example, in a bullish market, has all the buying power, all the buying pressure, okay? And the third candle wick low and the first candle wick high do not meet, therefore there's a gap, okay? As you can see, when we just explained about order blocks a second ago, we understood that when prices start to consolidate, we see a huge shift in momentum. That is usually then putting chunks in the market, right? Now, obviously, in terms of traditional order blocks, that should obviously be it, because obviously it's the left hand candle before this up move, and yes, you would look to trade from this. But as order blocks, in my opinion, is getting more mainstream, they're trying to hide it. This leads me on to the next subject in institutional trading, bank trading, to me, that's all bullshit. That's all just clickbait to try and get you to buy their course. They most likely have a course, or it's just their ego to make them sound better. There is no such thing as institutional trading. I get what they're getting at though, and I'll explain why in a second. But don't fall for that stuff. That's just a clickbait to get you to buy their course or whatever, or believe that there's some god at trading. When in reality, we will never really know how the banks trade. If anything, they have teams. They have a sales team. They have a trading team. They have a risk team. And you can go and study this if you want. The information's out there, but obviously we never really know. They have like the best algorithms, the best mathematicians that put it all together for them, and there's a whole different story. Anyways, I get where they're coming from though, because obviously order blocks, they are viewed as a footprint, so a footprint of where the large players are putting the money into the markets, and obviously where they are putting large amounts of money in the markets is obviously where it will retrace back to before putting in a higher price in this example, or a lower price in the bearish market, and vice versa, whatever, right? So that's just a footprint, and as it's getting more mainstream, they are trying to hide it. So this is where they'll start to hide it within, for example, this is a H4 candle, right? But if we go down to, let's say, the H1, as you can see straight away, there's the last down candle before the move. So it is there, right? You just have to find it. And that's pretty much it. But that's why it's important to, drop to the low time frame, and that's called refinement as well. But yeah, that's pretty much it really. I was just trying to think. Hopefully I haven't missed anything. If you do have any questions, make sure you send me a message on Instagram, or send it to the support team with our email, which is on our website. Or just head over to the contact us page, and one of the support team will reply straight away. So yeah, that's essentially it. Also, another way of them hiding it is within wicks. So if you understand what wicks are, obviously it's just a kind of wick like this, for example. They will usually hide them in that. So if you take a look at, let's say, this is equal highs here, right? Liquidity. Price wicks above it. Do a better example. Price wicks above it to take out that liquidity before moving down. And there's a candle, let's say, here. And that's the wick above it here, right? That wick, usually if it's a large wick as well, will act as a supply zone. Okay, and that's essentially them trying to hide it within the wicks. But and that's a great example of it here. You just saw this H4 candle, but on a lower time frame on H1, there was a very clear order block right there. So next up is obviously that's an imbalance anyways, where the first wick high and the third wick low, the candles do not meet. And imbalance just stands for when both buyers and sellers did not get a fair chance of liquidity. Therefore, price will have to rebalance itself, filling in that imbalance, and obviously fairing out the market essentially. That's the whole perspective behind it. Also, it must break structure as well. So as you can see here, we have a break of structure. Okay, whether this would be a chock or a break of structure, that's something for a different video. I'll go over that. But if you understand how I map out my highs and lows, this would be obviously a chock. And as you can see, this is a breakup market structure. So price is putting a new high. We have a huge imbalance, which is obviously this shift in impulsive move. Also, you can tie in things, like I said, let's sweep liquidity. So this did sweep outside liquidity. So it doesn't really make sense to, if anything, you want to be on the selling side, which is obviously here. This is a great example of a breakup block as well. So a breakup block is essentially, if you just look at it like this, right? The breakup block is where prices, obviously in this example, creating higher prices. We have a demand zone, price comes down, taps into it, it violates it. So obviously we keep that zone drawn up, but we extend it. We then create some liquidity here, price taps into it and creates a short-term move. And obviously you can look for a nice lower time frame trade within that, and that will obviously be a nice 1 to 5, whatever, right? And that's essentially a breaker block, but it's important that it must, understand that it must be through an imbalance, right? Breaker block through an imbalance. Breaker blocks isn't something I actively go out and look for and trade. But yeah. So imbalance, breaker market structure, sweeper liquidity as well. So ideally, if we just, let's say, price was, like this, and we swept this liquidity here, right, before breaking structure and putting in a new high, then obviously that would be a higher probability order block, right? So, like I said, sweeping liquidity is optional, but it must break structure and it must have an imbalance. Otherwise, if it doesn't have them two things, it's not invalid. It's important to understand your trading ranges as well. So if you don't understand trading ranges, go and watch my video on mapping out your highs and lows. my highs and lows videos is very unique and different to how a lot of people do it. That's why I have a very unique SMC approach, supply and demand approach, whatever you want to call it. It's very different, actually. So, for example, rather than trading from this order block, I actually look to trade from the candle that created the imbalance push, and it's all explained. My breaker structures, for example, I use wicks on the 1 minute, but body closures on the higher time frames. I mark out liquidity different. I approach the markets different. I take advantage of session timing. My highs and lows are based off a 3 candle method, so it's a simple rule based to follow. So yeah, that's why I'm different essentially. But this isn't me trying to big myself up or anything. I'm just saying that I trade it different. Obviously, I studied the whole order block and all that things before I obviously created my own little way of doing it. And it's a great way of trading. I feel like if you are going to come into the market, I feel like if you understand this way, you're going to have obviously a really good time. But one thing I just want to make clear as well is that it doesn't matter if you trade the basic break and retest, right? It doesn't really matter. However you trade, it's up to you. I used to be profitable trading other ways to trading, right? So it doesn't really matter, honestly. The whole sort of smart money concept industry can be quite toxic. So, if you are going to get into smart money concepts, I would recommend to be careful who you, really choose carefully who you follow on social media, because a lot of people will turn it into toxic stuff. Like, if you don't trade the smart money concepts way, you're not at their level, and it's stupid. For example, the likes of Tom Hugard, Larry Presavento, even Larry Williams as well, Brett Steenbarger, all these people, they all trade, very differently, right? Very, very differently. That's just a little motivation for you to just not give a fuck, focus on yourself. It's a personal journey. We don't need to care whatever people think. Just focus on yourself, and you'll be in a better place than you would if you listen to them or follow them. So, so going back to the story, so obviously what validates an order block is an imbalance, break a market structure, a sweep of liquidity before and then the order block's formed. That could be a high probability order block. Also premium discount. So if you know how to map out your highs and lows, you'll understand that this is your low and this is your high. Okay, if we just dragged it out, as you can see here, anything above this half is in the premium zone, and everything below this half is in the discounted zone. Okay, so why is this relevant? Well, because this would be our discounted zone, this would be our premium zone. Okay, so we ideally want to look for our order blocks within the discounted zone. We will not go and trade from order blocks in the premium zone because it's too high of a price. I've done a post on premium/discount. I'll probably do a quick video on it as well. But I've done an Instagram post on it. Yeah, you know what? I'll do a video on it after this one, but it probably won't be uploaded for a few days yet. But I have done a Instagram post on it as well, which if I do remember, I will link below. And you can go and check that out. It explains everything about premium discount. And again, if you read that, you'll understand why I have a crazy perspectives on the markets, because everything to me is about having a perspective. Because once you really understand it, and once you see things differently, you will understand things a lot more clearer. So yeah, those are the few things that validates order blocks. And as for what invalidates order blocks, is essentially just the opposite, right? For example, if this was a wick here and it was like this order block here, which obviously we've seen on the H1, would not be valid. Why? Because there is no balance, right? If this here was like this and we didn't break structure, this would not be a valid setup, as there's most likely a supply zone and you're on the wrong side of the market. Okay. Premium discount, if this was in the premium zone, this would not be valid. Okay, so just look at what first validates order blocks, and then obviously switch that and vice versa for what invalidates it, and things like that. And yeah, so in this video I've shown you a quick example of breaker block. I've shown you a quick example of premium discount and imbalance. I've shown you what an order block is, and my way or my approach is slightly different. So what I'll do is, if I try and pull up my Notion, I'll show you my Notion, and I've got some trades on there which you'll like to see. Bear with me. So if we just take a look. And we have, I'm just pulling up a few trades. As you can see here, if we just take a look at this one, right? I can just copy it on the charts. Will that do? Yes, it will. Okay, so as you can see here, this is a valid order block. Okay, we have this order block here, which is obviously the last up candle for the down move that was put in a break of market structure. This is a 1 minute time frame, so wicks are valid as breaks. This here is a adaptive entry, so you know if you're in the course and you want to study all this, go ahead. But as you can see, I marked out this candle here because this is the one that created the imbalance push, right? If we had marked this one out, yes, you still would have been in trade, but the risk to reward is much significantly better as opposed to this one. So I'm not favoring the risk to reward, I'm favoring what makes sense. So it must have logic, right? I'm not going to just go out and favor the monetary value of things, because once you start favoring the monetary value of things and trading, that's when things can get a little bit rough. I would never, place a trade because the risk to reward looks good, right? For example, so if you enter a trade, you put up the TP/SL entry, and let's say it's adding up to a 1 to 10 risk to reward ratio. Don't go and take it just because of the 1 to 10 risk to reward ratio. You'll lose the trade most likely, unless it's a fucking, you got lucky and you win. But never just favor the risk to reward ratio. It just creates psychological issues, so it's not worth it. But as you can see here, right, this is the candle that created the imbalance push. So what I did was obviously I just had my stops above the structure, because stops above structure is really important, because we know if it was to break this high, then we'd enter into a bullish market and we can start to look at buys and vice versa, right? Next example, if I can pull one up. So if we just jump on this one's actually a really funny trade. I was in this trade for, no, it wasn't this one, it was a different one. I'll show you a funny trade in a minute. But as you can see here, right, okay, that'll do. As you can see, this is the candle that created the imbalance push, whereas if you had this order block marked, you would not get in this trade. There's a reason why I targeted here, and there's a reason why I closed here, but I won't discuss that. But as you can see, this is the candle that created the imbalance push rather than the order block, and that's just a couple of reasons why mine's a little bit different to the average people. This here, I did trade from an order block as well, so as you can see here, right, we chalked back bullish. This here is an order block, right? I could have got away with trading from this candle that created an imbalance push, but the order block just sort of lined up with this one, so there was no reason to go and just mark this zone. So I just marked up the order block, and plus that was a low, hence why my stops were there. Little structure. And that funny trade I was on about, let me find it for you, because I was in a trade, right? This is a back-tested one. And I was in a trade for literally 0 minutes. If you just take a look at this, right? I traded from the candle that created the imbalance push. This was the structure low as well. Had my stops below structure, price tapped into it, took me out straight away. Right? This is beautiful. This is a 1 to 4. That was just beautiful. Okay. So that was a very crazy trade, and sometimes it will be like that. But yeah, so again, going back to order blocks very quickly. So it's the last up candle for down move, the last down candle for the up move. What validates one is an imbalance, a break of market structure, and premium discount. You can also look for other things which adds probability to the order block holding. So if you were to have this order block marked, right, this one here may not be as high probability as it would with one, let's say, sweeping liquidity. So if we just take a look at, let's say we have this equal highs here, right? So we have liquidity here. Price then wicks this. We can look at that wick as our supply zone and look to trade from it. So that would be high probability as opposed to this one. Okay, why? Because this one swept liquidity, this one didn't. So that adds probability to an order block, so you can look for things that swept liquidity. For example, here as well, this is a nice example of it, even though it didn't hold in the future. It's just a great example of it. Not all zones will hold. Just because you understand order blocks, by all means, it doesn't mean you're going to be right 100% of the time. If you're in the currency market, a strike rate of 50% is the average, in my opinion, or whatever. Obviously, it depends on your risk to reward and how you target, but you always have to be pragmatic about your targets. You know, for example, my old swing trading approach was 80%, 80 something percent win rate. If I can put it up, I have back tested it for, where is it? So I only done a few trades, and this is back last year. This is my old swing trading approach. You can go and look at it. I don't mind. Those are 2 trades. Right, this is a very old approach. But this one here, I'd like an 80% strike rate based off this back testing session. And yeah, you know, like I said, you can go ahead and look at these notes. It's completely up to you. And you can pause the video and go back on them. But yeah, that's my swing trading approach, and I had an 80% strike rate, and I hit about 80 an hour within that back testing session as well. And you know, it was much stress-free, a nice approach. One of the trades I held for 11 days and 20 hours, which was just crazy, which was this one. This was because obviously it's the H4 time frame, obviously swing trading. And yeah. Trying to think, right, if I miss anything, but what I'm trying to get at here anyways is your strike rate. It doesn't matter if your strike rate is significantly low, significantly high, whatever, as long as you're profitable over the long term. So if you just look at the overall equity curve, that's all that matters, right? You can have short-term down days, but as long as you just focus on that long-term approach, you'll be fine. But yeah, strike rates will differ for everyone. You know, you could have a 20% strike rate and be profitable. It depends on obviously your risk to reward. You could have a 6% strike rate and be profitable. You could have a 50% strike rate and be profitable. And again, you could even lose as well. So you just got to figure out your win rate and things like that. All you can do if you want to figure out your win rate is essentially just divide the number of wins by the total number of trades, and that'll give you your win rate. If I remember, I'll put the formula below. If not, just message me on Instagram and I'll give you the formula. And yeah, I guess, you know, I just winged this video. Hopefully you gained a lot of value from this one. If you have any questions, make sure you do message me. But remember those things, that what validates an order block. Switch to rolls, reverse. That's what invalidates an order block. We've spoken about a breakup block. And yeah, thank you guys for watching and tuning in. I do appreciate it. And watch as many times as you need to. Go over it, take notes so it really digs down into your subconscious. And any questions, like I said, you know where I am.